So this is a practice questions on statements of cash flow. So first of all, question 1. Which of the following events will appear in the cash flows for investing activities? And cash received as interest, yeah, this is a funny one. That actually appears in the operating section. Cash received from the issuance of common stock, that's of course a financing activity. Cash purchase of held to maturity securities, yep, that indeed would be an investing activity, and cash payment of dividends again is a financing activity. So the one investing activity here is just item C. Question 2. Which of the following statements is false for a cash flow statement prepared under the indirect method? And the indirect method, of course, remember, applies only to the operating section. So cash proceeds from the sale of equipment would be reported as a cash inflow under investing activities. Well, that's true, so it's not that one. Cash paid to pay back the principal amount of a note payable would be reported as a cash outflow under financing activities. Well, yeah, that's true. Next one. Depreciation expense would be added to net income in the operating activities section, and under the indirect method, actually that's true as well, so let's hope the last one is false. The gain on the sale of equipment would be added to net income under the operating activities section, and that's almost true until we remember, oops, no it's not, it's the loss would be added back, right? Because a loss at time of disposal is like extra depreciation, so we add back the depreciation, we add back the loss on sale of equipment. A gain, of course, would be subtracted. So the last statement here, item D, is false. Question 3. When preparing the statements of cash flows using the indirect method for determining net cash flows from operating activities, depreciation is added to net income because, well, without looking at the answers, why is there? Because it's an expense, but it's not a cash flow. So it was deducted as an expense on the income statement, that's true, and it doesn't require cash, so that certainly looks true. Let's hope the others are false. It was deducted as an expense on the income statement, yes it was, and affects the amount of cash, no it doesn't, so that's false. It's a significant portion of the year's expenses. That's clearly one for those that are just guessing, because it may or may not be significant. And because it represents a source or inflow of cash, no, it's not an inflow of cash, it's just that it was deducted. As we said in part A, it was deducted as an expense, but there's actually no cash impact. So the answer is A. Use the following information for the next 3 questions. Jimenez Computer Company assembled the following data related to its cash transactions, and then there are 3 questions to determine the cash inflow outflow from operating activities, investing activities, and financing activities. So it makes sense to look at all these cash flows and identify them. Are they increases, decreases, or inflows, outflows, and what section of the statement are they going to appear? So payment of dividends is of course an outflow, and that's going to go in the financing section. Collections from customers is an operating cash flow, that's an inflow. Payments to employees is an outflow, which is going to go in the operating section. Purchase of equipment is an outflow, that's going to go in the investing section. Payment of note payable, so that's a repayment of note which had previously been borrowed, so that's a financing activity, and it's an outflow. Next one is proceeds from issuance of stocks, that's an inflow, again a financing activity. Proceeds from the sale of land, that is an investing activity, and it would be an inflow. Receipts of dividend, and receipts of dividend is, it's this funny one, you might think that's investing, but no, under the way the standard was written, it's an operating cash flow, and similarly payment of interest, it's an outflow, but again that's an operating activity rather than a financing activity. And whether or not those receipts of dividend, receipts of interest, and payments of interest should be operating or other sections of the statements of cash flows was something which caused some controversy at the time the standard was introduced. It was not a unanimous decision, but under the current US GAAP these items are operating. And so if we look at the question 4, cash inflow outflow from operating activities, Well, we've got the operating, we've got 85,000 inflow for collections from customers. We've got a less 23,000 payments to employees. We've got a plus 3,000 receipts of dividend and a less 4,000 payment of interest. So do all those and it comes to a net 61,000, and so the answer is D. Question 5. The investing activities. Well, what are the investing activity cash flows? There's the purchase of equipment, which is less 71,000, and then there's just the plus 35,000 proceeds from the sale of land, so that gives us a net outflow of 36. And then question 6, the financing cash flows. There's a less 12,000 payment of dividends. There's the less 34 cash outflow for repayment of the note payable. There's the plus 18,000, the cash inflow from the proceeds of sale of stock. So if we do that, that comes to a net outflow of 28,000. So the answer is C. So next is question 7. A company sold some of its used equipment with a book value of 52,000 for 47,000, and so they made a loss on disposal. Right? If you think again, assets equals liabilities plus stockholders' equity, equipment goes down by 52,000, but cash goes up by 47,000. So overall, there's a net of 5,000 reduction in assets, and so that's going to be a 5,000 loss that goes through the income statement. And so when we come to do the statement of cash flows, the indirect method of the statement of cash flows will reflect a cash inflow, right, in the investing activities. So the inflow will be the cash proceeds, and the cash proceeds were 47,000, so it could be A or B. And then this loss on disposal, remember, a loss on disposal is like extra depreciation recognised at the time of disposal, and so we add back, so it's going to be an add back to net income to reconcile from net income to cash flows arising from operating activities. So the answer is B. Next is question 8. Partial financial results are presented below for the hamburger restaurant, and we have cash flows from operating activities, so that's a big inflow. Not bad. So it looks like it's profitable, spinning off cash. The investing activities, this is an inflow as well, so seems odd. Maybe they're disposing of something. And the financing activities, cash going out, so maybe they're repaying loans, maybe they're paying dividends. And the question says, what cash management actions are most likely occurred during the year? So, did they use cash from operations? They used cash from operations? Well, selling, yeah, that would be a possibility. They used cash, so cash is being generated from operations, and possibly selling long-term assets or selling investments, so both of those were inflows, and they used it to pay dividends. So that would certainly be a possibility. That's plausible. Let's see if there's anything better. Hamburger restaurant used cash from bank loans or from selling stock, so that would be an inflow. So yep, cash, so that could, oh no, hang on, financing. So if it was a bank loan, that would be an inflow from bank loans, so nope, definitely not that. Hamburger restaurant used cash from bank loans, so again no, because it was cash from bank loans, that would be an inflow in financing activities, and it's not. And selling stock to fund, again, selling stock to fund, no. And to fund operations, again, no. So this is wrong all over the place. And then hamburger restaurant used cash from operations to buy long-term assets. Well, no, because if they were buying long-term assets, it would be a cash outflow on investing activities. Repaid debt, yeah, that's possible, but no, definitely not. And so there is indeed only one right answer, plausible answer, and it's A. Question 9. Allen Company's 2009 income statement reported the following. Total revenues of 850, total expenses, including depreciation, of 40, was total expense of 720, the 2009 balance sheet reported the following. There was accounts receivable with a beginning balance and an ending balance of 50 and 40, accounts payable beginning and ending balances. Based on this information only, what was the net cash inflow from operating activities? So what we're going to do, of course, is start off with the net income, and the net income was, we haven't got that, so it must be presumably then the 850 less the expenses. We're not told anything about taxes, so presumably taxes are included in that 720. So the net income of 850 less 720 gives us a net income of 130. So we're going to say net income is 130, and then we're going to add back these reconciling items. So we add depreciation, because that was not a cash outflow, so we add back 40. We're going to look at the change in accounts receivable, and the beginning was 50,000, ending balance was 40, so that's a reduction in accounts receivable of 10,000, so that's good, that increases cash flow. There was accounts payable, which went from 22 to 28, so again that's good news. That's like borrowing an extra $6,000 from your creditors, so that's going to increase cash flow from operations. And so what we have is 130, 170, 180, 186, and so the answer is C. Question 10, similar to the last question. The Gradone company reported net income of something, net cash flow from operating activities of something. They give us this information and we're asked to find the missing figure. Okay, so we know that we're going to have the net income, which was 40, and we know that by the time we've made these adjustments, we're going to end up with cash flow from operations of, it says 47, working round thousands. So the net income was 40. There was a decrease in accounts receivable, and a decrease in accounts receivable is good news. Okay, that's cash being generated, so that's a 6,000. There was a increase in inventory, and that's bad news. That's like paying an extra 4,000 and therefore using some of the cash from otherwise that would have been received from operations, build up in inventory. We know there's a gain on sale of equipment, which we'll put in as X. We know it's going to be negative, at least it had better be. There's a change in unearned revenue. Remember, unearned revenue is a liability, so this decrease in unearned revenue means that we recorded some income but we didn't actually get any cash for it, so because the cash was received in the previous period. So this decrease in a liability, unearned revenue, is going to be a reduction in this list, and depreciation expense we know is going to be an add back, because depreciation is something we recorded as an expense but doesn't involve the movement of cash. So that was our 8,000 add back. So what we have then is that 40, 46, 42, 40, 48. So 48 plus X is 47, and therefore of course X is minus 1, and so this 1 is the gain, because we know we subtract the gain on the sale of equipment. It's like negative depreciation at the time of disposal. Question 11. Ireland Corp reported the following information. So we have some balance sheets, we have net income, some depreciation, gain on sale of equipment. If Ireland uses the indirect method to prepare the operating activities section of the statement of cash flows, what amount will be reported as the net cash inflow? So this is more straightforward. So again, we're going to start off with the net income. The net income is 80. We're going to add back depreciation, and the depreciation is 9. We're going to subtract the gain on sale of equipment, because that's like negative depreciation, so that's 5 coming off. We have this change in accounts receivable, and accounts receivable, be careful of the order of which is on the left, which is on the right. In this case, unusually, it looks like the earlier year is on the left. So accounts receivable went down by how much? That's a decline of 101 to 93. So that's -8. So that's going to be something that we add back to net income to get operating cash flows. It's an 8 we add back. Prepaid expenses went up, and so that means that we used some cash and haven't recorded the expense yet, but we used the cash sort of prepaying next year's rent. So delta prepaids, there's going to be a subtraction here for 1. There's the increase in accounts payable. So accounts payable goes up by 5, and we know, oh, that's good news, right? Because that's just like borrowing money from our suppliers. So accounts payable, we add this increase of 5. We have the salaries payable actually goes down, and so that's a change of, let's pull this down, change in accrued salaries, running out of space here, that's a decline of 1. That's like having to pay your employees more than, even though you didn't record the expense this year. And so overall we've got 80, 89, 84, 92, 91, 96, 95, and so overall cash flow from operations is 95,000. The next set of questions. Use the following balance sheets and income statement for Hanline Corporation to answer the following 3 questions. And we've got the balance sheet beginning of the year, or the end of the previous year, and then the next year. And again, this is more common format, that the more recent year is on the left. We have the elements there. We have an income statement. I don't know why that got missed off. Maybe, I don't know why that would be. Anyway, the income statement for the year ending December 31. And okay, what's the question? So, assume Hanline Corporation declared and paid all cash dividends in 2018, and then determine the cash dividends paid to its stockholders in 2013. And so we can get that. Do they tell us no? There's no dividend payable or anything on the balance sheet, so all the dividends were paid during the year. So what we're going to do is look at the movement on retained earnings for the period, because we know that if we look at retained earnings, we started off with a balance of 94,000. So started off with a balance of 94,000. We end the year with a balance of 123,400. We know that the net income was 97,800, so of course that's an increase in retained earnings, and so it must be that the dividends paid is the balancing figure. So we have X is, let's put that here, dividends are X, the X is the 94,000 plus 97,800 less 123,400, and if we do that it comes to 68,400, and so the answer is A. The next question, assume Hanline Corporation uses the direct method for preparing statement of cash flows. What is the cash paid for income taxes in 2018? And we can do that by looking at the T account for income taxes payable. So income taxes, we can see that the balance sheet at the beginning of the period there was 23,400 as a liability, and at the end of the period it had gone up to 35,900. We've got the income taxes expense was 68,000, so that would be a debit to the income statement and a credit to income taxes payable, and so the cash paid for income taxes, Y, so it would be a debit to income taxes and a credit to cash, then Y, we can see is equal to 23,400 plus 68,000 less 35,900, and if you do all that, it comes to 55,500. So the answer is C. And the last question, question 14. Assume Handline Corporation used the direct method for preparing the statement of cash flows and that all merchandise inventory was purchased on credit. Determine the cash paid for merchandise inventory in the year. Okay, and this is as bad as it gets. What we've got to do is look at the movement on the account for inventory and on the account for accounts payable. So if we look at inventory and accounts payable, we've got, I'm going to have to shrink this a bit, the beginning balance on accounts payable is a credit of 38,800 and an ending balance of 36,000. The beginning balance on inventory is 32 and it goes up to 34, so beginning balance of 32,000 and it goes up to 34,000. And if we look at the income statement, we can see that cost of goods sold was 238,000. So we know that must be a debit to the income statement and a credit to inventory of 238,000. Okay, so what was inventory purchased? Right, inventory purchased then is the balancing figure here. So it must be 34,000. The 34,000 plus 238,000 less 32,000. So that implies then that purchasers, the balancing figure here is 240,000. Okay, so that is going to be a debit to inventory and a credit to accounts payable. And therefore we can say that, okay, what is the missing figure on this side? Well, the missing figure on this side is a credit to cash and a debit to accounts payable, and it must be 38,800 plus 240,000 less 36,000, and so that gives us a balancing figure over here of 242,800. Okay, and I say that represents the cash paid to suppliers, and so the answer is C. Question 15. A company reported net income totaling 106,000. We've got depreciation expense, we've got changes in accounts receivable, changes in inventory, changes in these other elements of current assets, liabilities, what we call net working capital. And so we're going to be asked to find the company's cash flow from operations. So it's one where we're going to start off with the net income of 106,000 and then make the adjustments that we do for items which were in net income but sort of had an effect on cash. And so the first thing to do is to add back the depreciation, which we know is a non-cash expense, of 22,000. We're going to look at the change in accounts receivable, and accounts receivable decreased by 2,300. Oh, so that's good news. I should have worked in thousands. Is that anyone? Oh well, we'll leave it 2.3. So a decrease in accounts receivable is great. That's people, imagine there were no sales, no cost of sales. All that happened was that some customers paid you. So even though there's no net income, there would still be a cash flow from operations of this, in effect, the liquidation of the accounts receivable. So we add back the decrease in accounts receivable. Accounts payable decreased by... Sorry, the next one is inventory, isn't it? The change in inventory, what happened there? Change in inventory was an increase of 4,500. Oh dear, that's a shame. That means that we used up cash buying more inventory, even though there was no impact on the income statement. Accounts payable decreased by 5,000. That's even more bad news, right? Because that means, say, nothing happened. All that happened, we just used some cash to pay off our creditors by 5,000. So that's going to be a negative here. And then taxes payable increased. So at least that's some good news, right? We ended up, in effect, borrowing an extra 7,000 from the federal government this year, assuming it's federal taxes. And so overall, we have 106 plus 22 plus 2,300 less 4.5 less 5 plus 7, and if we do all that, it comes to 127,800, or 127.8 in my notation. So the answer is A. Question 16. Mavis Company's statement of cash flows showed net cash flows provided by operating activities of 47,000. They had increase in accounts payable, increase in inventory, depreciation, dividends paid. What was net income? Okay, so this is like the earlier example, except now we're going backwards. So net income we know is X, and we made these adjustments and ended up with cash flow from cash flow from operations, CFFO we'll call it, and cash flow from operations was 47,000. So how did we get there? Well, it was start off with net income. We would have added back depreciation, but apparently there was no. Was it? Oh yes, here we are. So we would add back depreciation. So that was 3,000. There was an increase in accounts payable, and we know that an increase in accounts payable, that's good news, right? That's just like borrowing extra money from your suppliers, so that generates cash. So that was 6. There was an increase in inventory. Oh, that's a shame. That means we had to go and pay cash for inventory even though we haven't got any income yet. So that was a 2,000 decrease. And then, is that it? Just those 3 things, nothing in accounts receivable. So accounts payable, inventory, depreciation, no. And of course dividends is nothing to do with operating cash flows, so we ignore that. And so what we have then is that X plus 3 plus 6 minus 2 is equal to 47, and therefore X is 47 plus 2, which is 49, minus 6 minus 3, and X is therefore 40? Yeah, 40. And so the answer is B. And the last question here, 17. Regina Corporation's 2012 net income is smaller than net cash flow from operating activities. So what we've got is a net income, right, with something, I know what it was, say it's 100, and it's smaller. So let's say it was net cash flow from operating activities, so perhaps net cash flow from operating activities was 120. Cash flow from operating activities. Which of the following would not be an explanation? Regina paid dividends to shareholders? Well, that's completely irrelevant, so I hope that's the answer. Which of these would not be a reason? Well, that's it. So definitely that one. Let's hope the others are possible reasons. B. Regina's accounts payable increased during the year. Okay, well that's like borrowing money, so yep, that's actually a valid reason for why cash flow from operations will be higher. They recognise depreciation expense. Again, that would be a valid reason because we know that we add back depreciation as we go from net income to cash flow from operations. And Regina sold equipment at a loss. Well, yes, because loss at time of sale is just like extra depreciation on that date. So indeed there is only one reason, and it is A. And that's it.